Hi, this is James Zhang, and today we're going to be talking about how to complete your schedule of real estate, why it matters, the sections, and then summarize just sort of how this all reconnects. So, remember we talked about on personal financial statement. They really want your net worth to be equal to or greater than the loan amount, and they also want 10% liquidity um, as a percentage of the loan amount. So, 10% of the loan amount needs to be equal to or greater than your liquidity. And a big portion of your personal financial statement really is the SREO, or schedule of real estate. And so lenders are going to review this, especially for these red flags, right? So they're going to look at debt service coverage if it's under 125. It's going to look at loan to value greater than 80%. They're going to look for loan maturities in the next 12 to 18 months. And then also they're going to look at occupancy. So if occupancy, let's say, is below 85%, that could be a red flag for them. And you're going to have to explain that in your SREO. So the sections of the SREO. So let me just give you some examples here. So let's go to personal financial statement, right? So we brought up this personal financial statement in a previous video, and you can see that here on the real estate side, they have about 1.1 million in real estate on the asset side, and about 400,000 in debt. So they're going to ask for more detail around that, and so I put it into the schedule of real estate, and this is what typically on the first cut, people will ask for your personal financial statement. And then once you get into the underwriting, they're going to ask for a schedule of real estate, which is a lot more detailed. And so here I put in or filled out just sample one. And we're going to go through these in more detail. Is really just sort of your NOI, the value of the property, the cap rate, the loan amount against the property, your total equity, debt service, debt cover, loan to value, maturity date, and then your ownership, and that's going to calculate your key principal equity. So let's go to the sections, right? So to start, the first couple columns are just going to be name, address, units, year built, year acquired, occupancy. That's pretty straightforward. Annual NOI, that's going to be taken, usually you can do like either a T12 on that in terms of income and expenses. And then your value, a lot of times if you just bought a property, plug in the value is fine there. But NOI divided by value, that first thing is going to be a cap rate. It's going to be a calculation that needs to be in line with market. So if you're buying a deal here in Dallas, you're probably 5.5 to 6% cap rate right now. In terms of loan amount outstanding, that's just going to come off of your mortgage statement, and then the value minus your loan amount is going to be your equity left. Annual debt service. Sometimes people mess this up on the single family side, but your annual debt service is really just your principal and interest, right? So your payment might include principal, interest, taxes, insurance, but really we just want to see your P&I payment on that annual debt service. And the reason is they're going to calculate NOI divided by your annual debt service to your debt service coverage. So, right, we want that to be above 125. LTV is loan to value, which is so loan divided by value, that they want below 80%. And then you're going to put in your loan terms, right? So interest rate, current lender, recourse, maturity date, equity, ownership percentage. And they need all that because you're going to calculate how much of the property's cash flow is coming to you and how much equity, right? So let's jump over back to the example here. So let's go through some of these. So personal residence, no cash flow because you live there. Your value is 400,000. Unpaid balance is 150. So your total equity is 250. You own 100%. And so your total equity is 250 in that particular transaction. Let's make this a little bigger. Duplex, so annual NOI. So this is income minus expenses. Your value is 250 for it. So that equates to about 8% cap. Loan amount is 100,000. So you have 150,000 in equity. Your payment's about 5,000 a year. So your debt service is more than sufficient to cover that. Your maturity is about 20 years away. And then you have good cash flow and your equities here at 100% too. Fourplex is very similar. So let's go into the syndication. So this is where, your property is $1 million NOI, value is about 16 million, so 6% cap. And then your loan amount is about 75%, and you have a good debt service coverage of 140. So on the annual debt service, you need to put your P&I payment, even if it's interest only, put your P&I payment there. Debt service of 140. And then loan to value 75%, good. And then it doesn't mature until 2025. And you own 1% of this deal for your 50,000 investment. So you want to make sure that your ownership reflects how much you invested in the deal based on the equity that you put in. And then let's go down to this last one, 350 unit syndication, 1.4 million NOI, divided by the value. So you get to about 5.5 cap. And then your loan amount and your equity, annual debt service again. So here, this is where some of the red flags are going to come up. So debt service is below 120. So that's going to be sort of a red flag for the lender. Same with the loan to value is 80% or 80.4. And you have a maturity in the next year. So you're going to need some lenders going to ask questions around, why is debt service coverage low? Maybe occupancy is low right now. Maybe rents are low. How are you going to deal with this maturity that's coming up? Maybe you put a bridge loan on the product or the property, and so you're going to try to refi the property now, and then matching up to your KP ownership here. And so your total equity, assets minus liabilities was 700,000. So you want to make sure your KP equity or key principal equity is the same in that slide. So, so those are sections of the SREO. So we had this. So we had the total assets minus your total liabilities should equal that KP equity that we talked about here on that Excel. And let's go back to. So here's just in summary. A major portion of most people's personal financial statements is schedule of real estate. So it's important to put all this in and get it correct. And so my background is as sort of a Texan underwriter at G Capital for 8 years. And then also as a lender on the multifamily space for the last 5 years, doing about 125 properties, over $800 million in loans, and also investing in close to 6,000 units over 21 properties in DFW, Austin, and San Antonio. So definitely subscribe to the channel, like the video, share the video, and join the email list. So you can go to txmultifamily.com and sort of set up time to talk with me, whether it's buying, selling, refinancing your next multifamily deal. First thing I'm going to ask you to do is complete your schedule, your personal financial statement, which contains your schedule of real estate as well. So thanks a lot for watching.